Huge has delivered a satisfying set of results for the financial year ending 28th February 2018, and the acquisition of Huge Connect and Huge Networks provided a base for substantial year-on-year revenue growth. While organic revenue growth in the underlying businesses has been muted due to the tough economic and socio-political conditions in South Africa, the group has seen the benefits of scale arising out of its recent acquisitions, as well as the benefits of more effective cost management reflected in the profit numbers. Huge enjoyed an 11-month contribution from Huge Connect and Huge Networks, and this resulted in group revenue increasing by 63%. Total gross profit for the group increased by 89%, while operating expenses increased by 47%. This position is largely attributable to the lower operating cost structures in Huge Connect and in Huge Networks. The formation of the holding company structure gave rise to new operating expenses in the corporate office group. This holding company structure has positioned Huge to continue to expand its customer real estate. It will allow Huge to consolidate additional businesses and grow its investment in data, payment, and voice connectivity services. This investment into building capacity is important if Huge is to manage an enlarged group of operating companies successfully. As such, the benefits of this investment will only accrue in later years. The telecom grouping achieved a 7% increase in revenue and gross profit and is comprised of Huge Telecoms and Huge Networks. While the telecom grouping experienced tough trading conditions, it was able to increase the base of installed telephone lines by 4%, its base of installed data services by 15%, and its base of monthly annuity customers by 6%. The FinTech grouping currently comprises Huge Connect. The company operates at high levels of efficiency, which contributed significantly to the improved operating profit margins of Huge. Huge Connect ended the year with a 2% increase in its ATM connections and a 5% increase in credit card terminal connections. Encouragingly, the company also grew its revenue from voice and data network services by more than 50%. The gross profit of the group increased by 89%, and its gross profit margin improvement from 48% to 55%. This was mainly attributable to lower cost structures in Huge Telecom and the strong operating efficiencies in Huge Connect and Huge Networks. In February 2017, Huge negotiated sizable reductions to its variable input costs, which has helped to lower Huge Telecom's cost structure and improve its gross profit margin. As a consequence of this negotiation, Huge was able to reduce the price per minute for each minute consumed by its customers. The gross profit margin is expected to improve as new customers are connected on this lower cost structure. As a business in a more mature stage of its life cycle, Huge Connect operates at a much higher level of cost efficiency. The addition of Huge Connect has therefore had a significantly positive impact on the gross profit margin of the group. The improvement of key operating cost metrics at a group level is largely attributable to the operating margin profiles of Huge Connect and Huge Networks. The operating margin efficiencies in Huge Connect in particular have offset the relative increase in costs associated with creating the corporate office structure. Total group operating expenses increased by 47%, which percentage increase is less than the increase in total group revenue of 63%. This can be attributed to lower operating cost structures in Huge Connect and in Huge Networks. Huge is embarking on a strategy to centralize the treasury functions of the group. In future years, the cost of debt are expected to be more effectively managed as a result of this centralization. The board intends to maintain an optimal capital structure in terms of its capital structure policy, which provides for a debt-to-equity ratio ceiling of 25% as a guiding parameter. The current debt-to-equity ratio of Huge is 14%. Basic earnings per share increased by 80% from 26.3 cents per share to 47.4 cents per share. Headline earnings per share increased by 76% from 26.3 cents per share to 46.34 cents per share. Net profit after tax increased by 188% from 26.8 million to 77.1 million. EBITDA in the current financial year is 145% higher than in the prior financial year, off the back of an improved EBITDA margin, which increased from 21.4% to 31.9%. Total revenue increased by 63% from 245.9 million to 401.3 million. Operating profit increased by 168% from 42.2 million to 112.9 million.